He joins us now. Good to have you this afternoon. I was about to say this morning. That's typically my beat. Chris, where do you think we stand right now in terms of what you're seeing in the market action, what you've heard from our panel so far in the program?
If we just looked at yesterday, David, and I know you talked a lot about this morning, yesterday's rotation was unprecedented. We saw a lot of that during the actual throes of the pandemic, mostly in the long duration growth areas. But if we just take a step back, this cycle is very different than any other cycle, and for obvious reasons. So I think when we look back on this, if we go forward about 8-9 months from now, and we look back on this, we'll call this the post-pandemic cycle, one in which is potentially a job-full type of growth recession that hurts earnings because of the post-pandemic build-out. And the big shift from goods to services is where the employment gap is. And goods spending is coming down, manufacturing is harmed, and there's an energy equation going on in Europe we've never seen. So it's really hard to suggest that we're in a cycle of past. So what we're doing is we're getting more defensive. We're going to continue to diversify our multi-asset portfolios, and we're actually looking for opportunities between now and when the Fed may actually pause in the early part of 23. Last point here, David. Most importantly, in the next 6 months, Steve touched on this before, it's the Fed and its forecasts of earnings. Earnings have to come down. And that's the last phase of a cyclical bear market. And when that happens, that's an opportune time for long-term investors to really start to look for opportunities.
Right, but we've already had multiples come down in advance of or expectation that earnings are going to come down. What we're all waiting for is to see just how much, and obviously guidance becomes such an important component of that as well.
Exactly. And the big bear camp thinks that this is a classic recessionary cycle that's going to take earnings down quite a bit. What's quite a bit? 30% or more. In some cases, like 2000, 2002, almost 50%. We think it's going to be substantially less than that. A deterioration of some 10% might kick multiples down just a small point from there. But trying to time that, it's going to be virtually impossible. So I think you need to use capital market weakness to your advantage when that happens, probably post Jackson Hole, and then again sometime in the early part when the Fed ultimately starts to say, we're potentially done here.
Right. All right. Well, you mentioned getting more defensive. So what does that mean? Does that mean raising cash, or does that mean moving into pharma, for example, which has been quite a strong sector this morning, not to mention much of the year?
Yeah, I think when you kind of step back a little bit, if you have a multi-asset portfolio, some yields prior to the latest move lower were looking pretty attractive. Extending duration is one way to get a little bit more defensive in the fixed income world. If you're looking at a sector portfolio, you said it there, healthcare can provide you less of a downside in the multiples because they really have underperformed up to recent times, or at least through the pandemic, they underperformed a lot. They give you some growth, some income. Consumer staples is another area. Utilities is a mixed bag, but also is another area to consider. And then bookend that with some of the what we call the world-class technology areas that also will pay you a dividend and have corrected substantially already. So kind of a barbell in your sector approach. And then overall, just in terms of cash, if you're building cash right now out of your portfolio, have it ready, have a plan ready for those two time periods to opportunistically rebalance to the upside, to get ready, because we still think eventually we'll come back to this secular bull market. We're just got to get through the pain right now.